On today's Hashi, I'm discussing the May FOMC minutes, the lock-in effect, and the millennial home buying intent in 2025, as well as our weekly unemployment report. Today is Thursday, May 29, 2025. I'm Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Let me know in the chat which market you are tuning in from today. Wherever you may be, let's connect better together right there in the live chat. All right, before we get into it with the FOMC minutes, I've got to mention this bump on the futures were up, and now coming into the morning, they're not up as much as they were. Okay, so last night, and this is tied to the FOMC minutes, because they're kind of tied together on the greater, economic watch that everybody is seemingly going through right now. You saw the market move up. Dow was up like 500 points on futures last night when this court decision to block the administration, President Trump's tariffs, which was breaking news late last night, if you missed it. So, federal court decision to block Trump tariffs. Obviously, there's going to be some type of an appeal to that. So maybe that's where overnight the market now, because the market's only up like just barely. It's gained a little bit here this morning. So it went up as high as 500 points on the futures. And now at market open, which is right now, it's seemingly come down to just flat. There's not much. NASDAQ's actually up a little bit more, but NASDAQ might be driven by NVIDIA's strong results yesterday. I think that is the case. And NVIDIA had really good earnings, strong results. So that might be the bump NASDAQ. So when we're looking, is there a bump here from the federal decision court that makes this decision here to go ahead and block the tariff? There was initially, and now there isn't. We're going to get into what the FOMC in the minutes say about tariffs as a whole and what their concerns are. But really just looking at CME Group, what's the Fed's decision going to be in 20 days? They're unchanged from last night's news. In fact, it's up a point. It was 97% that they would not cut. It's now at 98%. So the market seems to me now overnight has this, belief that, okay, this isn't like, a final decision. There's going to be an appeal. There's going to be maybe, a Supreme Court decision. These kind of things are, I think now are what being taken into account. All right. Let's get to the FOMC minutes. So this gives us a deeper look from the May 6, May 7 meeting. The FOMC release their minutes, basically halfway between the last meeting and the next meeting, every time. And we've got last meetings now. So we've got an inside look on, what were the conversations? What were the concerns? We know what the decision was. We know what Jerome Powell said at the presser, but really what were some of the concerns and what were, for us, particularly on this, what were the conversations around housing? So inside of the show notes, it's uploaded into School for BAMX members. We've pulled the 5 paragraphs in the notes that have to do with housing. Okay, so pages 6 through 7, paragraph 1, there was one mention of housing. Rates on the 30-year fixed conforming. Mortgages edged down. We know now this is dated news because they've edged back up. We're back to 7% rates. Okay, they're talking about the yields increase from already elevated levels, and including investment grade corporate bonds and senior commercial mortgage-backed securities. Those rates edged down. Interest rates for credit card offers inched up. So that was one mention. Paragraph 3 on page 7, consumer credit continued to be generally available for most households. Credit continued to be easily available for high credit score mortgage borrowers, was not easily available for lower credit score borrowers. So we still have a really tight and restrictive. Compare the ability to get mortgage credit, to borrow mortgage from today versus right before the great financial crisis. It's night and day. It's 10 times harder. There's less capital. All those things remain to be true. FOMC acknowledging it there on paragraph 3. Page 7, paragraph 4 in the notes, talking about credit is stable for large and mid-sized firms. Most categories of mortgages and consumer loans. It's deteriorating in other sectors. So credit is stable. It's available for the highly qualified on the mortgage. Regarding household credit quality, the rate of serious delinquencies on FHA, Federal Housing Administration mortgages, continue to rise in February to above pre-pandemic levels. By contrast, delinquency rates on most other mortgage loan types remained at historical lows. So big difference there. When you put those all into one group, it's still below pre-pandemic levels. Everything outside of FHA loans is well below pre-pandemic levels. On the total, we're still below pre-pandemic. FHA is slightly above pre-pandemic levels. The FOMC acknowledging that. There will be interesting to see, with this Fannie Freddie. It's been a busy week for the administration. We'll see what the Fannie Freddie, or I'm looking forward to seeing what Jerome Powell says about it in 20 days. The Fannie Freddie potentially going, or not potentially, it's a guarantee from the administration. They're going public. We've looked at the stocks that seems to be, or not, going back private sector rather. That seems to be, the scenario that the belief from investors since inauguration, even before inauguration, since the election. And so the guarantee from the administration that will not move rates up remains to be seen. Equity valuations declined, but stood in the upper end of their historical distribution. And this is talking about housing valuations remaining high, and there's risk to economic outlook in the appearance of those high values. The last mention of housing, several participants highlighted the persistence, the magnitude and the persistence of potential increases in inflation. So there's still a concern about inflation, and reason being tariff increases, ongoing trade negotiations, less tolerance for price increases by household. So this weakening of the economy, they go on to say, reduced housing inflation pressures from lower immigration. So the Fed has got a concern that there is going to be an aggravation to inflation due to what's been going on with tariffs. Now, we got this new news last night that maybe tariffs are going to be stopped here for a while. There's a lot of negotiations going on, so some of them were going to be stopped anyway. We'll see if that sticks, if that court decision, I'm certain it'll be appealed. We'll find out more today. But 20 days ago during the meeting, or really 3 weeks ago, I guess I should say, during the Fed meeting, they expressed concerns that tariffs could worsen inflation, complicate interest rate decisions. So anticipate what CME Group is anticipating, a pause in 20 days from today when they have the next meeting. Obviously, we know they voted to keep that Fed fund rate steady. That's what CME Group is saying they're going to do again. And just kind of more wait and see, collect more data. It's probably more of what we'll hear. All on board were in agreement to take a cautious approach. Doesn't seem like that has wavered only 20 days out. They are acknowledging that there are potential trade-offs if inflation remains persistent while growth and employment indicators weaken, that they're going to have to do some trade-offs, meaning cut, right? But we haven't seen employment weaken. I mean, the best example of this, okay, people are talking, even the FOMC is talking about like, oh man, what are we going to do? here, if the economy weakens and we start to, that recession word, comes back, keeps, kind of bubbling up. We've seen from Logan over and over again that you got to watch employment. Right now, employment hasn't started ticking down in residential construction. That's one of the biggest indicators of a recession. We're going to look at unemployment for the week. We haven't had hard data. We've had some soft data. Oh, this job could be lost or that job. We haven't had hard data that suggests employment is going to weaken enough that's going to make the Fed react, and they're not going to react until they see that. Okay. So doesn't mean that concern's not out there. We just don't have the data to show that is the case. All right. So that's really kind of the big takeaways here. The uncertainty continues in the Fed's mind, and it shows up in the meeting minute notes. Okay. Realtor.com put out some thoughts on where Americans are at on the lock-in effect. Okay. So the lock-in effect for Americans, as well as just where millennials are at on home buying. Okay. This is a report that they put out. It suggests that 23% of millennials plan to buy a home in the next 6 months. That's interesting. The time of year that we're in, when you look at mortgage application data, a winning streak of 13 weeks in a row, up week over week or year over year for 13 weeks in a row. I know we've had some down weeks on the week over week data, but I'm talking about 13 straight weeks of plus year over year data. Maybe this is why 23% of millennials plan to buy a home in the next 6 months. That's up 15% from September 2024. So this is despite the fact that we're at the 7% rate. Like, I know this might be one of the biggest numbers of the future is bright that I've seen. Okay. Which of the following do you plan to do in the next 6 months? This is sign a lease or rental agreement to rent a home. Okay. So this red bar is today. The gray one is September 2024. So people planning on renting or at least down 2%. Buying a home up 3% from 11% to 14%. Selling a home up 1% from 3% to 4%. None of these 70% to 69%. Okay. So millennials are planning to move on with their life, whether that be out of the lock-in effect to sell and then to buy on the other end, or to buy the first one. Nearly 1 out of 4 millennial respondents indicated that they're going to buy a home in the next 6 months. That's a jump up about 10% from 15% in September. Just 14% of all respondents plan to do the same. Okay, so millennials seem to be the most aggressive moving forward here over the next 6 months on a seasonal decline time in the market. Here's the next piece of data that's interesting. How strongly do you agree or disagree with the following statement? I have delayed purchasing a home due to high mortgage rates. Okay. So overall, 17% strongly agree. 25% for Gen Z would strongly agree. 23% millennials strongly agree. Gen X, 15% strongly agree. And boomers, 9%. Boomers don't got to worry about it. They control a lot of the wealth. Okay. So not as big of a concern there for boomers. There's some questions to be asked, right? Like if someone were to say, hey, I got a delay just basically due to mortgage rates. Okay. If you were able to negotiate on a home that brought the value down, what if you were able to bring the value down enough where the mortgage rate, where the payment was more important than the rate? Would you still be looking then? Okay. What if the rate didn't come down? How long would you wait? What about the rate being at a certain number is important? Is it payment, or is it just that you want a lower rate to be able to say you have a lower rate? Like I would dig in 3, 4, 5, 6 questions deep on that to find out really what's the concern. Okay. because there's a lot of information that's probably missing. Do you think that there are people thinking just like you? If you're a millennial, hey, 1 out of 4 millennials are thinking just like you. So when rates come down, what happens to this 23% right here? Do they re-enter the market? I mean, 24% of millennials agree. So 1 out of 2 millennials either strongly agree or agree that they've delayed purchasing a home due to high mortgage rates, which means when rates move down, they re-enter the market. That's a pretty good chart right there to walk somebody through that 1 out of 2 instead of just saying it. At which mortgage rate would you consider buying a home? That's a question. Hey, what mortgage rate would you consider buying a home? If I could get the house $50,000 less, would you consider buying this? Because the payment kind of washes out, right? So less than 2%. That number, at what mortgage rate would you consider buying? Less than 2%. Don't even have that as an option, Realtor.com. I love you guys, but wow. I mean, it'd be like, it's like misleading people so much. Nobody's getting a less than 2% mortgage. 2.1 to 3% is the next category. So interestingly, look at this. This is what I think is mortgage rates don't impact my decision to buy a home. You got 23% of millennials say it's not going to make an impact. Gen Z, 29%. All adults, 32%. 1 out of 3 buyers say, hey, 1 out of 3 buyers are saying, I'm not basing my home buying decisions off what the rate is. I'm basing it off my life. I'm basing it off of what I need in life. That's interesting. Okay. I mean, the less than 2% is so, yeah, of course, 17% of millennials would consider buying a home at less than 2%. Everybody in the world would consider it. You'd be silly not to. Which of the following sources did you leverage to finance your home? 57% personal savings, 36% financial institutions, banks, 15% personal investments, 14% retirement accounts, 12% gifts or loans from family members. They're more common among Gen Z and millennials at 18 and 15. Overall, it was 12. Only 7% assistance from the government, 6% employer benefits or assistance programs. And then you got a couple other smaller categories there. So where homeowners were able to get the money to move forward on the purchase, do you plan to leverage to finance your home? Okay, so this is those that are buying in the next 6 months. What are their plan? They're pretty similar to what we had on homeowners there. Personal savings and financial institution banks, top 2. Retirement accounts, 28%. I mean, you see the 401k on those tax implications with that. Shows the strong desire for home ownership. People are willing to take a tax implication on 401k, 28% to buy a home. People want home ownership. I mean, if 28% are willing to take that type of hit on their future retirement, that should show you something. Personal investments, 27%. Okay. I put a bunch of this data in for you guys into school. So BAMX members, you can just grab it, right there. Just jump into school, go to the classroom for hot sheet every day, upload all of the show notes, as well as the charts that are going to be useful for you and your business on a day-to-day, week-to-week basis. Tomorrow, we'll have all of the new weekly content dropping right here in this classroom. So make sure if you want to access all that, you get into BAMX on school. All right. Let's move into unemployment. This is the one thing the Fed said it in their meeting notes. This is the thing they're watching closely that hasn't broke. And until it breaks, do not expect the Fed to pivot on the rates. Okay. We got a week here of maybe higher than what we've seen. It's higher than the 4-week moving average. So maybe we are moving in that direction. Initial claims here for the week come in at 240,000. It's an increase of 14,000 from the previous week's level. And the 4-week moving average is at 230,750. So it's 10,000 above the 4-week moving average. And It's an interesting note. Something to note. Like, you got to get up over 250,000 on that 4-week moving average for people to start really getting concerned about this. This is still really low, historically speaking, in terms of the unemployment rate. 1 week of kind of, is this it needs to be multiple weeks to be a trend. Is this a trend, or are we going to come back next week and see 222,000? Which we've seen that happen a lot when we see these soft little pops up. So it's 1 week of data. If we see this now consistently get that 4-week moving average up over 250,000, that could put pressure on the Fed to start dropping. 10-year moves down a little bit. We're down to 4.442. If we look at the last 90, this is still pretty high level for the last 90 days. 30-year fix yesterday came in at 6.98. Was hoping for maybe a bigger move here on the tariff deal, but it doesn't seem like the market is totally sold on that just yet. There's your hot sheet here for the week. I think, Haley, do we have we have another office hours today too, I think, right? Is it office hours or public webinar? I think we have an office hours. We have, for members, we do. We have a 2 o'clock, 2 p.m. Eastern office hours on Facebook ads. Bobby and I did a YouTube one yesterday. So members, jump into that 2 o'clock. That's what's coming up next. We'll have a walkthrough here on the YouTube channel today, as well as a new Knowledge Brokers tomorrow over on Knowledge Brokers Pod. Hope you enjoyed this week of the shortened week of the hot sheet. Be back next week. See you guys inside of BAMX members. I'll see you in the chat on some of the other pods, Knowledge Brokers tomorrow. And until then, of course, toodaloo.